It's time for the Phil Ferguson Show.
Buongiorno tutti. This is Phil Ferguson, and you are listening to the cleverly titled The Phil Ferguson Show. Thank you for being here. I am so excited. We have a brand new year, 2022. Woohoo! Hopefully 2022 is better than the last couple of years. It's off to a shaky start with the whole Omicron being Finch thing, Omicron variant of COVID. But maybe with a little luck, it'll burn through fast, and hopefully no one else ever goes to the hospital or gets sick, but kind of worried that they will. But with a little luck in a couple of months, we'll see some daylight at the end of the tunnel, but I will not be surprised if there's more waves, or if COVID kind of becomes not pandemic, but endemic, like the influenza. It's just here. I can't believe I just compared it to influenza. It's not like the flu, at least it wasn't. But there's a long history of viruses that mutate, and sometimes they mutate and the probability of you dying goes up. But viruses that tend to spread the best are often ones that don't kill the host, because if it was very, very efficient at killing you and did it, really quick, it doesn't have time to spread, and so it just burns out. So ones that spread more quickly are often less deadly, but you can still die. So, don't read too much into that, because I don't know what the fuck I'm talking about. All right. But something I do know what I'm talking about after we take our little break is a nice long segment on how different types of investments, how different indexes, different market segments did in the calendar year 2021. Overall, the quick and dirty summary is U.S. stocks crushed it as a whole. Absolutely fantastic. Maybe too good. International stocks, they did okay. They didn't do what U.S. stocks did, but international around the world on a collective whole made some money, made reasonable amounts of money, but just nowhere near as good as domestic. And bonds, it was rough. It was a rough year. So I'll go over all those details near the end of that segment. So that segment is long and with a lot of math, so I'm going to get to it here real quick. Just a quick update on my solar panels. And I haven't done the actual math on it, but the installers suggested, proposed, recommended, predicted that I would get about 13,000 kilowatt hours of energy. Yeah, that's how that works during a calendar year. And by golly, that's about what I got, maybe a little bit more. The savings, of course, depending on your utility and electricity rates. Mine is about 12.5 cents. So off the top of my head, I saved $1,500, $1,600. It's nice. The panels, after allowances, credits, and rebates, I was out of pocket around, oh my God, it's been over a year since I did it, around $12,000. So if I save $1,600, it's going to be 7 to 8 years. Of course, if utility rates go up, I'll save the money faster. And with a little luck, the panels will last 20 to 25 years when I have to redo the roof. And I would expect by then that solar panel technology has improved sufficiently enough that when I redo the roof, I would put on new, better solar panels. But definitely enough energy created by my system for the average house. Our house is bigger than average, and I work from home with multiple computers and monitors and stuff. So, and two electric cars. The average U.S. household can use around 800 to 1,000 kilowatt hours in a month. So even at 1,000 a month, this system, for an annualized basis, would cover all of your electrical needs. It won't cover your electrical needs in December because it doesn't make much in December, and now we're going into January, And we'll have probably some times where there's going to be snow sitting on the panels and they're not going to produce jack shit for January, but that's okay. In the best months, by the way, are April and May because you have a lot of sun. And for me, my tree hasn't really put on too many leaves yet. I have one tree that blocks the panels a little bit. And the middle of the summer, it's actually lower because the panels get hot and they're not as efficient when they're hot, even though there might be more sun during the day because the sun's higher. Fascinating stuff we learned, but yeah, April, May, maybe even the first week or two of June are amazing, depending on the weather and the temperature, how much solar energy they collect. We'll take a quick break and we'll go into 2021 performance year in review. And I know you're going to love it. And I might have a break in the middle of that just to break it up. So we'll see how good my mixing is because I didn't have an intentional pause anywhere in there. So I'm just going to suddenly, you'll hear me talking and then suddenly it'll be something different. But hopefully that wakes you back up and you can finish the show. Enjoy.
He loves you and he needs money. He always needs money. He's all powerful, all perfect, all knowing, and all wise. Somehow, just can't handle money. Religion takes in billions of dollars. They pay no taxes, and they always need a little more. Now, you talk about a good bullshit story. Holy shit.
You're listening to The Phil Ferguson Show.
This Investing Skeptically segment is going to have a lot of numbers, so hopefully you're not driving. You may even want to be with pen and paper or an Excel spreadsheet open where you can type some stuff in. If you're that interested, it is the annual review. And in this case, it is January of 2022. And I am going to go over the performance results of many different market segments, U.S. stock market, international stock markets, the REIT fund from Vanguard that I use, and a bunch of different bond funds. And during that process, of course, I will inevitably share some thoughts and opinions on those things. So keep in mind, all of this is just information. Maybe educational, maybe, dare I say, entertaining, but it is definitely not specific investment advice for you. It is not personalized for you. These are generic thoughts and comments that you might find educational. Of course, do your own research, check the numbers yourself, and if you have a financial advisor, consult with them. And if you don't, you probably should have a tax professional. And again, if you're just getting started out and you have one job, maybe you don't need a tax professional. But if you have several hundreds of thousands or millions of dollars in investments and or you own a business or you have income from multiple places and a lot of things going on, pay the extra money for a tax professional. I'm just saying, you're going to love it. So let's start with the S&P 500. Oh, I almost forgot. I'm surprised. I had many, many emails from listeners telling me that they're waiting for this show, which means you're all a bunch of weird fuckers because you're waiting for me to do the math, which is cool. I love you. I love you so much. How many shows have that where people actually want some of the math and a bunch of numbers? Anyway, S&P 500, the easiest, quickest place for you to check this, of course, is either Vanguard.com, because they've got all the year-end numbers up for their funds. Morningstar, I double-checked some of the numbers at Morningstar to make sure that they matched. And Morningstar has better numbers on the Vanguard index funds that are international, which is weird because Vanguard doesn't make that easy to find. And for this first number, of course, Wikipedia, the Wikipedia S&P 500 page. And I probably need to do a whole episode some point in the future on the S&P 500 and or stocks and or index funds. Oh my God, so many things just bouncing around in my head. 2021, breathe. I can do this. 2021, the total return, including dividends, for the S&P 500 for the calendar year of 2021 was 28.71%, which I may often call 28.7, but 28.71 is what Wikipedia is showing. That's a lot of fucking money. Now, keep in mind, that's on top of the 18.4% the year before and the 31.5% the year before. So if you had put in $100,000 into the S&P 500 at the beginning of 2019 through 2019, 2020, and 2021, you would have double that amount if you added nothing. So your 100,000, I'm roughly, I haven't done the hard math on this, but roughly you'd have double what you would have had when you started. That's amazing. That's not normal also, by the way. And so this is one of the things why I have been saying for, I don't know, a good part of a year, if you are 15 years or less from retirement, double check your cushion. Make sure it's big enough. Make sure you're on pace to get to retirement. And if you want to be a little extra conservative for what I normally say, would not bother me at all. So if you're on your way to retirement and your portfolio is doing great and you made a lot of money in the last 3, 5, 10 years, just keep in mind the market does not go up. As an example, in 2018, the S&P 500 was down 4.38%. And in 2015, it was up, but only 1.4%. Calendar year 11, it was up 2.1. But 2008, of course, it was down 37% in 1 year. Now, it took a few years to get back to even, but it did, and then it roared. Also, calendar years 20, 21, and 22 were 3 years in a row, 3 calendar years in a row, where the S&P 500 was down -9, -12, and then -22 in 02. So it can happen. It may happen again. I don't know. Keep in mind that really painful 3-year drop was after 5 years, from 1995 through 2000 to 1999. 5, 6, 7, 8, 9. Yeah, 5 calendar years where the market returned at worst 21% 1 year, but as much as 37%, 33%. But it was 21% or higher for 5 years in a row. Again, not normal. And I think we are now getting to a time. Keep in mind, I'm not saying to panic. I am not saying to go sell all of your stocks. Matter of fact, if you are 15 years or more out from retirement, keep on trucking. Just keep putting money in stocks. Even if it goes down 50%, you have lots of time. And you have lots of time to add while the market's on sale. So the best way is to not time it, because if you had looked at 3 years of great success back in the late 90s, 95, 96, 97, let's see, we had 38%, 23%, 33%. If you had said, oh my God, that's too much, and you started pulling money out, you would have missed the 29 and the 21% that came the next 2 years, which would have easily added 50% to your portfolio. So market timing is notoriously difficult. Not only do you have to be right at the time to get out, but you have to be right at the time to get in. And who knows when those points are. And additionally, if you sell a whole bunch of stuff, you might have transactional costs and tax costs. So 15 years or more from retirement, you just ride it. You don't think about it. You don't worry about it. Your job is to add more money and invest smart. Closer to retirement, we're building the cushion anyway, but we might just be a little more aggressive with the cushion, which means your portfolio is more conservative. But anyway, again, nothing crazy. I'm not saying sell 80% of your funds, but if the right number for you in the cushion works out mathematically to be 30%, and now you switch to 35%, I'm good with that. I really am. We've made a lot of money. Anyway, that's the S&P 500. That's the U.S. stock market. Well, it's the 500 largest stocks in the U.S. stock market. And now I'm going to look at some other numbers here as I pivot over to the other screen. The extended market for the U.S., which is everything that's not the S&P 500 is up 12.45%, which historically is a fantastic number. 12.5% on mid-cap and small-cap combined, the extended market, as it's called. Absolutely fantastic. It just looks small compared to the roughly 28% from the S&P 500. Currently, my recommendation is about half in large cap and half in not large cap. So if you did that and you had half making 28 and you had half making 12.5, obviously your results are somewhere in the middle with about 18 or 19%. Again, not bad at all. Now you could look at that and go, but Phil, if I had all of it in large cap, I would have made more. Yeah, you would have. We don't know that in the future. What I do know is that if I look at long-term numbers, which, let's see, 5 and 10 years. Short term for me is 1 to 3, maybe even 5 years. Short term is not later today. So I'm not doing anything daily. I'm not doing anything weekly or monthly. It's usually a calendar quarter might be the quickest I generally do something. But we're talking in years. The large cap growth index fund, which is VIGAX, over 10 years has now returned 19.3% per year for 10 years. That's a lot. That is now getting up to the area where I am a little concerned. Now, one could argue that the world has changed, and that number is driven by a lot of things to do with the stocks that we all hear about in the news every day. Facebook, Apple, Amazon, Netflix, eBay, all the really big names that have grown a ton in the last 5 to 10 years. And if you've had money in those, and of course, if you've had this fund, you had money in those, you've made a lot of money. Even the worst performing segment, which I also adore, is the small cap value fund. It's up 13.3% per year for the last 10 years. The norm, depending on how you look at it, is 9 or 10 or 11, including dividends and not taking out for inflation. 9 to 11% is the normal U.S. stock market returns. Historically, which is interesting, value stocks and small cap stocks in the long run outperform large cap and growth stocks. Sometimes for years, sometimes for a decade or more, this is the case. We are now in a part of history where that is not the case, where it has been for the last 10 years plus, that large cap stocks have done better and growth stocks have done better. I would not be surprised if at some point in the future that switches. So let's go through the 6 funds that I generally use for the U.S. stock market and what they've done for the last year. And these are large cap growth and value, mid cap growth and value, small cap growth and value. Again, all of this you can find on Vanguard's site. All of this you can find on Morningstar's website, these numbers. Just a 1-year number to start with. Large cap growth, 27.3. Large cap value, 26.5. Ironically, amazingly, I'm not quite sure, those 2 funds generally make up the S&P 500, but both of those numbers are below the S&P 500. That's interesting, maybe because of stock overlap, where these funds, while they are mostly unique, sometimes there are stocks left over when a stock switches from growth to value. And even though these 2 funds have very little overlap, there are some stocks that they share in common. Mid-cap growth, 24.5. Nope, that's mid-cap in total. Mid-cap growth, 20.5. And mid-cap value, almost 29. So that did really well. Small-cap growth, under 6%. Wow. And small-cap value, 28%. So it looks like in mid-cap and small-cap, with the 28 plus, you did quite well. Mid-cap growth, no slouch at 20%, but small-cap growth was under 6%, which you might think, oh, well, that's awful. Yeah, it is awful for this calendar year, but that would be a place for you to look at to see if you're now out of balance. The others, when they're off a couple of percents for just 1 year, may not put you out of balance anywhere. But here's one where if all the U.S. segments are up 20% or more and small cap growth is up less than 6%, it might now be too small of a percentage based on your plan that you've made for yourself. You don't have to do what Phil says or talks about, but the most important thing is to have a plan and to follow it. I get a lot of emails this time of year about rebalancing. I love it. Once a year is fantastic, but you don't have to get too carried away with it. You definitely don't want to balance daily, weekly, monthly. Quarterly, maybe. If you have a really big portfolio and you really like doing it once a quarter, I could work with. Maybe twice a year. I do it for my clients as warranted by the creation of cash or large market swings, or if their accounts are smaller, probably once a year. For most people, doing it more than once a year is time consuming, could be costly, etc. If you also have a large portion of your portfolio in a taxable account, be careful. Be careful because the very act of rebalancing is selling from the biggest winners and adding them to the ones that haven't done as well or who were losers. This logic, I don't think, applies to stocks and also doesn't apply to market sectors, but the market segments that I use. So that may also affect what you plan to do. If it's in a taxable account, you may create tax consequences. So just pay attention to that. Mostly it's going to be long-term gains, at least with the U.S. stock market part. Maybe you can balance inside of your 401k instead. If your taxable account doesn't have 50% large cap, but has 70% large cap, can you change the investments in your 401k so that they're the opposite way, where they're 30% large cap and 70% small cap? So in total, you've balanced out and you've been able to make those adjustments without creating taxes. Just some things to think about. So overall, the U.S. stock market has done really well in the last 1 year, particularly well in the last 3 years, and surprisingly, even very well since the end of 2008, the beginning of 2009. So what is it, 12 plus years, almost 13 years of generally up market? That's a long time. And it's interesting because when you look at the 1 year numbers, even though with, in this case, only one of those segments broke out and did something different, the small cap growth of 6%, there are times when we've had this in the past where one segment is up 20 to 30% and another one is up 1 or 2 or 3%. Not a normal. But when you go to the long run, the numbers are, the best is large cap growth of 19.3. And the worst we talked about before, VSIAX, small cap value, is 13. That's a pretty big spread, but almost every segment, ignoring those two, is 13, 14, 15%. So while the difference within a calendar year might be 20% or more, the difference in the long run is often 2 or 3%. And this is, again, that confirmation, I guess, reaffirmation of the dollar cost, not the dollar cost averaging, the rebalancing and regression to the mean, at least for these segments in the U.S. stock market. Another thing I like to use in moderation, no more than 10% of your stock portfolio, and even 5% would be okay as a smaller number, is the REIT fund from Vanguard, VGSLX, for the last 12 months, ending 12/31 of 2021. Its return was 40.4, 40%. That's amazing. Absolutely amazing, and probably unexpected by most people, given how commercial real estate and just general real estate for business has done, but maybe not too surprising because a lot of this is also residential and home prices have gone up. And so the REIT investments, which is investments mostly in companies that deal with real estate, but it can also include actual homes and properties, buildings, but mostly it's companies that do these things. That part of the U.S. market is up 40.4%. Clearly, that is a lot. That is fantastic. Interestingly, the 10-year number here is 11%, which puts it below every single other segment that I use for the U.S. stock market. If you were rebalancing, this is a place to look at to possibly sell something. And I forgot to mention earlier, one of the other ways you can rebalance is by adding money. And this is very easy to do when you're starting. So if you're 35 and you've managed to get up to $100,000, if you add $10,000 during the next calendar year, you could do the bulk to all of your rebalancing with the new money. You just put the new money in the places that have gotten weak compared to what your plan is. And again, exactly the percentages that you have in your plan, it's important, but it's not maniacally important. The important thing is to add that $10,000 and add it to the part of your plan that has suffered if you're doing something kind of like how I'm doing. But REITs, if you're in retirement and you need money out, or you need to fill up your cash position so that you can continue to take money out, this is going to be a place that you should think about looking at. You don't have to sell all of it. I'm not saying that, but skim 5 or 10% off as a starting point to build up your cash for the next several months or part of the year for taking cash out for your monthly deductions in retirement. I'm going to transition now to international stocks, and the Vanguard Total International Index Fund, VTIAX, is up in the last 12 months 8.6%. Pretty normal, 8.6, almost 9, kind of like one of those normal years, unlike the U.S. stock market. So international had a year or two where it did better than domestic stocks, but this year is not one of those. Again, historically, over really long periods of time, 20, 30, 50 years, international stocks return generally the same amount as domestic stocks. I have been saying 25% plus, maybe 30% of your stock investments should be international. And with this very weak performance relative to the U.S., I'm going to now increase that to 30%. Yes, that's right. You heard it right. Because international is lagging, I want more of it. With the hope, with the expectation that returning to long-term historical norms, international generally returns about 10% per year, just like the U.S. stock market does. But it's been soft over the last years, way better than what it was if we looked at this 4 or 5 years ago, because there was a period for almost 10 years where international stocks made 1 or 2%. It was pretty bad. In this year, it's 8.6. Not great compared to the other things, but not horrible. And again, if we look at the 10-year numbers, for example, the 10-year S&P 500 is 16.5, and the total international is 7.7. So pretty good spread there. International is lagging, has lagged, did lag for the last 10 years. But will it do so in the future? I don't know. Part of it is the ability to have different investments, just like we talked about within the U.S. stock market part, what I call the U.S. market matrix, those 6 funds that I use. The small cap growth might be the place you want to add back into to fix it, to put it back in balance. International is now a place where maybe if you take some money out of large cap growth or other positions in the U.S. segment, maybe you don't put them in the cushion, but maybe you put them in international. Who knows? That's the problem. I don't know the future. I'm not going to pretend to know the future. With some rare exceptions, I'll make what I think are hopefully educated guesses. But as far as stocks, what's going to happen in the next year or two? Almost anything can happen, which is why I want to be in all these different segments to take advantage and to be able to rebalance. When I break up and I look at some of the international funds that I use, and again, all Vanguard, and this is the first 2 I'm going to talk about, is a very rare exception. It's the only 2 funds that I use that are not specifically index funds. They are managed funds, but their expense ratios are around 0.3, 0.4. So very, very low, but I couldn't find any index funds that I liked that did what these 2 funds are doing. And the first one is international growth, and the next one is international value. This is typically very large companies, very large international companies. They're often very much developed in developed countries. So if you've ever seen, you could get a developed fund for international developed fund, and this is going to kind of sort of be in that ballpark. But the growth fund, the managed growth fund, had a return of negative 0.7, and the value fund made 8%. So that's interesting. Why that difference? Again, these create possible points where you would rebalance if you're already doing something like this. Also, I use 10% of the international each in the Pacific and the European index. The Pacific index was up 1.5, the European up 16%. That probably had mostly to do with China. And how China is going to perform in the future, again, we don't know. It might be that the Pacific index does way better in the next 12 months or the next 5 years. We don't know. And again, of course, this is why we have so many different funds. Just popped into my head a little caveat. This is for large funds. This is for people that have 500,000, a million or more. If you just have 20,000, using the Vanguard Total Stock Market Index is fine. Using Fidelity's Total Stock Market Index is fine. Using Schwab's you get the idea. When you have a small portfolio, having it just in the U.S. stock market index, total market index is fine. The biggest problem for you is you don't have a big portfolio. You have to get there. And sometimes people will get a little carried away and want to have 10 or 12 or 15 different funds when they only have $80,000. It's fine to think about that stuff and learn about that stuff, but the biggest thing you can do is save more money. That's the biggest driver of your portfolio. So if you find you're spending a lot of time trying to figure out what to invest in, maybe you should just go get a second job and earn more money to throw into the portfolio. And the last two international funds, international small cap up 13%. That's the Europe did 16, small cap did 13, and emerging market fund, the Vanguard Emerging Market Fund, had a surprisingly, amazingly meh year. It made 0.86% positive, which is positive, but that's the one fund, that's the most volatile fund historically out of all of these, that sometimes in a year could lose 50%, sometimes 1 year, more than a decade ago, I think, made something like 70% in 1 year. So that's why we have that. So I'm leaning towards rebalancing into international, perhaps increasing your international exposure a few percentage points. I have been drifting towards 30. I think my last formal recommendation was 25% plus. I'm now feeling more comfortable with 30. And I've been drifting clients that way for months now. And of course, the people who are paying me sometimes get information before the regular listeners, who I adore, but you're not paying me. So there's that.
The longer you live, the more you look around, the more you realize something is fucked up. Something is wrong here. War, disease, death, destruction, hunger, filth, poverty, torture, crime, corruption, and the ice-capades. Something is definitely wrong. This is not good work. If this is the best God can do, I am not impressed. Results like these do not belong on the resume of a supreme being. This is the kind of shit you'd expect from an office temp with a bad attitude. And just between you and me, in any decently run universe, this guy would have been out on his all-powerful ass a long time ago. And by the way, I say this guy because I firmly believe, looking at these results, that if there is a God, it has to be a man. No woman could or would ever fuck things up like this. So,
hey, poor! You don't have to be poor anymore! Jesus is here!
The Phil Ferguson Show is for educational and entertainment purposes only. Nothing said on the show should be interpreted as personalized investment advice. Investments should be based on your personal situation, and you, of course, should consult with your financial advisor or tax professional before taking any actions.
You're listening to The Phil Ferguson Show.
Let's go talk about bonds for a little bit. Of course, in bonds, I use about 75%, give or take, of the cushion of the bonds. Should be in fairly conservative, maybe painfully plain and vanilla funds. You don't have to use the exact funds that I use, but what you want to look for is high quality, and any decent bond fund will tell you, or you can look it up at Morningstar, what the rating for the bonds are, what the bond fund is. You're going to want A, AA, or AAA, AAA being the best. AAA is generally reserved for a handful of incredibly well-off companies that have bonds and or U.S. Treasuries. If you have corporate stocks, you can easily get A and above, A, AA. It can have a mix, and it can have some BBB in there, but you don't want it to be primary. And it's one of the things that could be a potential problem, is that if you have a conservative short-term corporate bond fund, as an example, and the salesperson that talked to you said, oh, you don't want to make just 1 or 2%. You can have this short-term corporate fund that makes 5%. How do they do that? How do they do that? That's not magic. What they have to do is they have to take risk somewhere. And the two main drivers for risk are the length of the fund, the length of the bonds owned in the fund, which you can, again, easily see at Morningstar, or the homepage for the fund that you're investing in. They either have to go out longer in time, or they have to go down on the risk table. And if that's what you want, that's fine. But for me, the cushion is meant to be, I don't know, painfully boring. So I'm using 3 different funds. I have one that's basically mostly U.S. government bonds. I have one that's mostly short-term corporate bonds. And then I have the Jenny Mae fund, which did lose 1% this year. And of course, the dividends on all of these are small. So the yields on these funds are around 1%, and for the corporate one, around 1.4%, which is nice, but it's not a whole lot of money. And if you need the money in a year or two, honestly, keeping it in your bank or a CD at your bank might be the easiest thing to do. Keep in mind, if you get a 3 or 5 year CD to make a little bit more dividends, interest, you might have a bigger penalty if you need the money out. So these funds, the yields 6 months ago were closer to 0.5%. So this is a big increase, which is nice, from 0.5% to 1% or more. But that's partly why the funds went down. So as an example, VBIRX, which is a Vanguard short-term fund that is a good part in U.S. Treasuries, but I think it also has some corporates. It went down 0.99. It lost 1% in the last year. And again, that's caused mainly in this specific fund by the increasing interest rates, mostly at the very end of 2021, where we are now in a period where it looks very likely that interest rates are going to go up. The Federal Reserve, which we talked about in detail a few episodes back, has indicated that they now plan to not only stop or reduce and or stop quantitative easing, where they're buying bonds and pushing up the price, and that also pushes down the yield. That's a whole nother show for you. But they have talked about increasing the federal funds, the Federal Reserve Fed funds rate, overnight bank lending rate, from approximately 0 to 0.25, might increase by 0.5 to 0.75% in the next 12 months. So as an example, if interest rates go up 1% in the next 12 months, and this fund that I just talked about has a duration of 3, and again, you can easily find that on Morningstar. You want to know the duration of your fund, because that's likely, no guarantees, likely how sensitive that fund is to interest rate fluctuations. So that fund has a duration of 3, which means if interest rates go up 1 percentage point, that fund could lose 3 percentage points. And of course, it's never exactly that easy, because the interest rates will change over time. It doesn't go up by 1% tonight or tomorrow. It doesn't go up in a known and predictable date. It's whenever the Fed announces it. And of course, if a fund has an average duration of 2.8, like this fund does, every year it's replacing a good part of the bonds that they own, because the bonds become due and pay off or pay back the money that was owed. And so in a short-term bond fund, again, a duration of 2.8 means that every year they're probably selling 30, 33, 35%, or not necessarily selling, but those bonds become due and they cash out and they take that money and they buy new bonds. Well, the new bonds will have the higher interest rates. So you probably won't lose 2.8% if the interest rates go up 1%. But, it gives you an idea. And of course, keep in mind if the fund, which it is now paying a dividend or a yield of 0.94%, if you lose 3 and you make 1 from the dividends, from the yield, you're net -2. I see that as an unlikely lower end scenario. It could be that as they're switching out bonds, that this fund does in 2022 kind of what it did in 2021, which is -1%. If they switch out bonds faster, if the interest rate increases happen later in the year, just depends. It could be break even. It could make 1%. And I think that's the ballpark we're looking at here for very conservative short-term bond fund. And again, the purpose of this fund is not to make a lot of money. It's to be there in case the stock market part goes down. Short-term corporates, the loss for the last year is 0.33, minus 0.33, and its yield is now up to 1.4%, which is nice. And again, the Vanguard fund that I use for corporate at Vanguard is VFSUX. VF sucks. Interesting combination of letters. Again, a duration of 2.8. It might make money. It has a better chance of making money because the yield is a little higher. But it could be 0 to nothing. It could be a little bit negative. And keeping in mind, this fund in particular is a Vanguard fund that has been around since 2001. Its long-term history is a positive 3.5%. Not bad, not great, but that's why it's there. It's just to stabilize everything and be a little bit better than cash. Just for laughs, I'm going to now look at Vanguard's long-term corporate. And this is a duration of 18.7 years. Duration 18.7. The average maturity of the bonds in the portfolio are going to be around 18 years. But the quick and easy calculated number is 18.7. Here is a situation where if interest rates go up 1%, the fund could lose 18.7%. If it has a current dividend of 1.8, that will offset some of the losses. So if interest rates go up 1%, you might lose only 16. This is one of the reasons I am not recommending intermediate or long-term bonds generally at all, especially not high quality bonds, because junk bonds aren't as sensitive to interest rates because they have other risks, but they're really conservative. They're really, quote unquote, safe and reliable long-term U.S. government bonds. I'm definitely staying away from them. And this last 12 months, that fund, which I'm looking at here, VLGSX, lost 5%. So nowhere near as bad as it could have been and nowhere near as bad as it might be. Keeping in mind long-term interest rates generally don't move as quickly as short-term interest rates. But again, this is a fund that, while we are still at record low interest rates, could lose 15, 18, 20, 30% in the next year or 2 or 3. It might not. It might go back to making money. And this fund, by the way, for reference, since 2010 has returned 6.5% per year on average. You're not going to get that. I mean, if something weird happens with the economy and all of the interest rate increases stop going up and the Fed continues to buy bonds because the economy suddenly got soft from a viral outbreak, maybe for a short period of time, this fund will be positive again. But the small extra yield that it can provide is not worth it to me for the possibility that I could lose 15 to 30% in the next couple of years. Not interested. Now, this is a great fund, and I've used this in the past, and we've made a lot of money on it with it in the past. I just don't see that happening because of the current environment now. The Jenny May Fund, which is VFIJX, and this one does have a $50,000 minimum to get into this fund. So again, if you only have a couple of $100,000, look for the non-admiral shares of this fund. But this fund is down about 1%. It has a duration of 2.5, and it also is home loans, packaged home loans. And they generally don't respond the same way, but they might. They don't always respond the same way as the other short-term bonds, at least in reference to changes in U.S. interest rates. And part of that is that when interest rates go up and mortgage rates go up, for 20, 30-year mortgages, a lot of people, if they can, they just don't refinance. So these tend to move a little slower, which is nice. So that's the bulk. 2/3 at minimum, maybe more like 75%, maybe 80%, maybe a little bit over 80% if you want to be really conservative with the bond fund. And then there's 3 other funds that I use that can add a little spice, can add a little excitement, and maybe not even good excitement, which has been the case this year. But these are bond funds that might make more returns in a given year. They might have bigger losses in a given year. And some of it's because of the differences in what they are. And I'll go over that for a minute. But before I do, I want to go into the total bond index. Again, this is something that if you have a small portfolio, maybe 500,000, and you don't want to have 6 different bond funds, you just want to have one, or your 401k might have a total bond fund. It's okay. It's not great, but it's okay. The current yield for the total Vanguard total bond fund is 0.55, which is really low. I'm surprised how it's that low. I might have to recheck that. Hang on a second. I'm going to pause. You'll never know it because I'm going to come right back and tell you. And I'm back. See, did you miss me? It took me a minute. I wasn't looking at my spreadsheet correctly, so it's nice to know that I thought that might be inaccurate because it was. The total bond fund current yield is 1.57, which is more what I would expect because it has conservative bonds, it has long-term bonds, it has a little bit of junk bonds, it has a little bit of everything. In the last 1 year, 12 months ending December 31st of 21, this has a total return of minus 1.67. Thankfully, luckily, sometimes my guesses work out, and a mix of bond funds that I have been recommending for the last year had a return of minus 0.6. So not minus 1.6. So if you did something kind of like what I'm suggesting, you outperform the total bond market index by a good percentage point, which is nice. That's hard to do. But I digress. The other 3 bond funds that I use to kind of spice up things are the Total International Bond Fund, the Emerging Market Bond Fund, and then Vanguard's High Yield, also known as junk bonds. And again, to follow up on a previous segment, I don't hate junk bonds. I think they should be in moderation. Where I worry about is when people show me a portfolio that has half of their money in junk bonds and they don't know that half their money's in junk bonds, or the funds that they're using sound like really safe and conservative bond funds, but they're filled with junk bonds because the person that's recommending these things to you does not want to tell you that the current yield, the current interest rate you could get from a short-term U.S. government is around 1%. Because a lot of customers might say, well, no, I don't want 1%. I want 3 or 4%. Oh, well, why didn't you say so? Well, yeah, we can put you in the Vanguard Junk Bond Fund, current yield 3.36%, and over the last 12 months made 3.8%, and in the really long term, since 1978, this fund has made 6.5% per year. So you can make money in bonds, and you can make money in junk bonds. It's just not necessarily every year. You might have a year where you lose money, and it can be a lot. Junk bonds often lose money at the very worst point is when stocks are down. Not always, but March of 2020 was a beautiful, beautiful example when the stock market went down 30% or more in a month. The high yield junk bonds did pretty much the same because junk bonds are often issued by companies that are struggling. So when the market is down, there's increased fear that those junk bonds will not be able to pay the yield that they've promised, and they might not be able to pay back all the money that they've promised. So something to use in moderation. So again, since the bond fund, the bonds overall did so poorly, they might be out of balance again, because if your stocks made 18, 20, or 28%, and your bond portfolio made nothing or lost 1 or 2%, again, you might want to rebalance back into the bonds. Now, for the sake of simplicity, if you're at retirement, the way I calculate it is complicated, and I don't even know how to describe the math in detail, but to cheat, to make it really easy, if you're really aggressive, 30% of your portfolio in bonds, maybe 40% for the average person. If you're really conservative and you want to have half of your retirement portfolio at retirement in bonds and half in stocks, that's fine. But it also means that for the last 12 months, half of your portfolio not only made nothing, but it lost something while the stocks were on a tear. Making nothing looks stupid. I get it. It does. It looks really bad. But if we have a year where the U.S. market is down 30 or more percent, making zero with half of your money looks brilliant, and it's not going to stay at zero. But it was a really bad year for bonds, rough year for bonds. So that's some information. Again, if you're young and you're only in stock, and if you're only in U.S. stocks, 28%, 28.7% is what the S&P 500 made. It would be great if you were close to that number. If you have managed funds, if you have your own stocks that you pick and buy and sell, based on the data on lots of investors and lots of mutual funds, you probably dramatically underperform that number. It can happen. You might be the one person that beat it. You bought and put all of your money in one or two really good stocks this year, and 28% you laugh it off because you made 60%. Well, congratulations. You did it. This advice is not for those people. And matter of fact, I generally recommend against buying individual stocks because of the cost involved, which can be very low, by the way, the possible tax consequences if you have to buy or sell in a taxable account, and the very fact that most stocks perform poorly. It's a handful that do exceptionally well. And if you pick from that handful of exceptionally well-performing stocks, you can kill it. But the odds are if you're buying 10, 15, 20, even 40 or 50 stocks, only one or two are going to be the big hitters, and you could still underperform because a lot of other things don't do well. So the U.S. segment, 28%. If you're in a mixed bag of stuff, 25, 26%. Managed funds, maybe in the low 20s. If you're all stock, or you think the funds that you have are all stock, and you're making less than 20%, or you made less than 20% in calendar year 21, you should look at what you own. You might have some problems in there. International, again, depending on how you look at it, what funds you have, 8%, maybe 8.5%, maybe 7%, that kind of ballpark. If you have a portfolio that is 70% U.S. stock and 30% international, maybe your return is more like 17 or 18%. If half of your portfolio was in bonds, then you're not making the 18%, you're going to make 9%. So it depends. What's your goal? What's your objective? And I'm not generally going for the very best return in a very small, specific time period. I am trying to get really decent, really good, hopefully close to or beating the index, maybe, but with a reasonable amount of risk. So if you put all of your bonds in junk bonds, in the last year, you beat what I did. Easy. Instead of losing money, you made almost 4%. And your bond portfolio made 4% where mine didn't. Congratulations. If you're okay taking on all that risk, that's cool. That you be you, man. But I'm trying to balance a lot of factors. I want decent growth, and I want reasonable volatility and reasonable risk. I would much rather see a statement where I open it every quarter that is just a little bit bigger than the quarter before. And hopefully not too many times is it less. And if it is, not a whole lot less. I want to reduce that volatility, and kind of like in the fable of the tortoise and the hare, I'm the tortoise. Slow and steady, although a big chunk of our portfolio is U.S. stock indexes, which are up around 28%. That's not necessarily tortoise area, but you get the idea. So this little 20-minute segment is now pushing 50 minutes. So I'm going to wrap it up. And I appreciate you listening. If I misspoke something, which is possible, I went over a lot of stuff. Or if you think there's something I should have covered, or you want my thoughts on a different type of investment or whatever, and how it might have done in 21, you can let me know. But I'm going to wrap up. This is the segment, ending of the segment for numbers and results of different types of investments for calendar year 2021. The Phil Ferguson Show is for educational and entertainment purposes only. Nothing said on the show should be interpreted as personalized investment advice. Investments should be based on your personal situation, and you, of course, should consult with your financial advisor or tax professional before taking any actions. Wow, was that a lot of numbers? That was a lot of numbers. I mean, if I didn't have this big spreadsheet in front of me, I don't know. I couldn't have done that. That was a lot to remember. Hopefully, it helped you. I think the short takeaway is U.S. made 28, give or take. And if your portfolio is U.S. stock managed funds and you made 12 or 15%, take a look at it. You might need to make some changes. You cannot afford to lose so much money in up years. For most people, it's not the down years that kill them. It's making way under what you could on the up years. And so then the down years seem that much more devastating. And I have not found yet something that can protect you when the market goes down, but then allow you to have all the money when the market goes up. So this kind of, I mean, we just face the risk where appropriate in the U.S. stock market. Sometimes it goes up a lot, sometimes it goes down a lot, but on the whole, in the long run, it goes up and up and up. 10% historically, more recently, maybe that's justified, maybe it's not. Again, interesting stuff, but hopefully you did well, and hopefully you continue to do well. And if you have questions, you may let me know. You can ask me. Quick reminders, Patreon, if you have an account at Patreon and you support the Phil Ferguson Show, please go turn off your support for the Phil Ferguson Show. I am no longer even charging you the $1 or $6 or $10 or $20 or whatever you committed to. I'm not collecting that anymore, and at some point I will probably turn off the link or turn off the page at patreon.com/Phil just because I don't even want there to be an appearance of conflict of interest where you're contributing money to the show and then you call and ask me a question and I answer it. So I'm perfectly happy to answer most questions for free. The one weird caveat, until I am more comfortable in the new regulations, giving you opinions on your current 401k is going to be tough. It's going to be tough because according to the Department of Labor, if I give you a recommendation and move your money from your 401k into an IRA that I can see and manage and get paid off of, that is technically called a prohibited transaction. It's just flat out not allowed. And of course, with the government, when they tell you it's not allowed, they mean it's not allowed until you do the thing that makes it allowable. And that's where I'm stuck. I don't know exactly. I'm getting more and more information each week. And hopefully soon I'll have an answer for you. But there is an exemption process where you can collect certain data and kind of justify that your advice is still good, which is kind of what it means to be a fiduciary in the first place. So I think the whole thing is fucking redundant. Something that I've been doing for the best interest of my clients for more than 2 decades is now prohibited unless I go through some extra steps to show why it's okay, which it was in the first place. But whatever. That's the government for you. So if you call me and say, hey, Phil, should I move my 401k over to an IRA that you manage? I'm going to say something like, if that's what you want to do, or you could choose to do that. And of course, if you send me an email, I'll respond in that way that I can't recommend it. Literally, it's prohibited. I can't recommend it unless I complete the exception and document it. So I might say I can't recommend it. If that's something you want to do, you are, of course, at liberty to do whatever you want with your investments. You can contact any advisor you want. You can contact an annuity salesperson and say, I want to take my money out of my 401k and have you manage it. You can tell that to your manager, and then they're not recommending it. You're telling them what you want them to do. I think that covers it. But at some point, I will figure out what the rules are, and I'll have a form that I'll have to fill out, and we'll both probably have to sign to show that we went through the process of figuring out whether it was actually in your best interest or not to move your 401k to an IRA. Anywho, enough of that. Nice long show, lots of numbers. Again, I hope you benefited from it. I'm hoping to get someone on from American Atheists. This is my fault so far. I haven't asked because I've got so many other things going on. To talk about their convention in April for Easter weekend. I think that's around the 15th of April. So hopefully we are in a lull, or we're mostly over COVID or the rapid spreading. I don't know. But I'm optimistic. And at this point, I'm pretty sure I'm going to go to Atlanta for Easter to be at the American Atheist Convention. So hopefully I can see you there. Until then, ciao.